Hello, glad you all could join us. My name is Eric Trost. I'm head of the Tax Technical Services for SBA, and welcome to our seminar. Today's seminar, we'll be talking about R&D credits and some rule changes that have occurred during the year. And we've invited a leading specialty firm, KBKG, to discuss these R&D credits with us. So they'll be leading the seminar. I'm going to turn it over to them. Little housekeeping, if you have questions, please enter them on the chat. I'll be monitoring the chat and submit the questions as they come up, or we're going to try to hold them all to the end unless we see something come up that's particularly relevant right on topic. We'll hold them to the end, and we're going to leave about 15 minutes at the end for questions. So I'm going to turn it over to Kyle Ernsberger right now from KBKG. And again, KBKG is a leading specialty tax consulting firm that helps other accounting firms and clients such as yourselves discussing tax credits and other sorts of tax specialty things. With that, I turn it to Kyle.
Thanks so much, Eric. Hi, everyone. Just as a quick background, if you're not familiar, as Eric mentioned, KBKG, we primarily focus on value-added engineering-based studies for credits, deductions for companies and owners and individuals. And KBKG was formed in 1999. We have offices across the country in Los Angeles, Dallas, Atlanta, New York, and Chicago. And so we're a complementary asset to your typical CPA and tax professionals. So as Eric referenced, R&D is one of the areas we focus on. I'm going to invite Michael Maroney, who's a director in our group, to speak about some of these changes. Michael's been with our firm for quite a while and has done nothing but R&D tax credits for about 25 years. So Michael, take it away.
No, thanks. Thanks, everybody. And thanks, Eric, for hosting this. Appreciate it. So let's go ahead and get kind of into what is the Section 174 R&E expenses. Why are we talking about this now? So just real briefly, here's an agenda. We're going to talk about the Section 174 changes to the Internal Revenue Code. We're going to talk about the interplay between Section 174, which is the used to be the deductions. Now it's the capitalization and amortization, and the Section 41 credit for increasing research and development expenses. And then finally, we'll talk briefly about the distinction between the words carrying on versus in connection with. That's a little teaser, and we'll save that for the end. So let's talk about Section 174. So IRC, that's the Internal Revenue Code, Section 174, was originally enacted in 1953. The proper tax treatment of domestic and foreign research and experimentation expenses was either to deduct them fully in the year that they were incurred or paid, or to capitalize and amortize them over the life of the project. When disposing, retiring, or abandoning the R&E project, you could either deduct or recover when abandoned. And then software development costs, they were allowed to be deductible under Revenue Procedure 2000-50. So that was very popular, and it had been around for 60 some odd years until the Tax Cuts and Jobs Act changed that. So under the new 174 rules, and that's enacted beginning after December 31st, 2021, taxpayers must capitalize and amortize their research and experimentation expenditures over 5 years for domestic R&E and over 15 years for any foreign research. Taxpayers continue to amortize assets for disposition, retirement, and abandonment, but software development costs must now be capitalized and amortized. There's no special treatment either under Rev Proc 2000-50 allowed for the specified R&E expenditures for software development costs. So as I mentioned, for 68 years, taxpayers have been able to deduct its R&E expenses fully under Section 174, and this changed in with the passage of the Tax Cuts and Jobs Act. So I'm going to read a little bit on the slide here for you. The congressional intent from the House report was that no specific treatment is authorized by present law for research and experimental expenditures. To the extent that they are ordinary and necessary, they are deductible. To the extent that they are capital in nature, they are to be capitalized and amortized over useful life. Losses are permitted where amounts have been capitalized in connection with abandoned projects, and recovery through amortization is provided where the useful life of these capital items is determinable, as in the case of a patent. However, where projects are not abandoned and where a useful life cannot be definitely determined, taxpayers have had no means of amortizing research expenditures. So this excerpt from the congressional notes shows the original intent of Congress at the time 174 was enacted, or the discussion leading up to its enactment. If the expenditures are ordinary and necessary, they're deductible. If they are capital in nature, they are capitalized and amortized. Losses are amortized over the useful life of the project. But if the useful life is indeterminable, there was no means of amortizing these expenses. So again, under the old Section 174, the ordinary and necessary language from 174 is the standard for deductibility under IRC Section 162. So if you have an ordinary and necessary business expense, it has always been able to be deducted under 162, and they're using the same language, ordinary and necessary, as they did in the congressional notes for the 174 code section. These expenses are deductible when incurred by a taxpayer in carrying on a trade or business. So we've got the congressional record from 1954 here shows that a discussion was held prior to the passage of IRC Section 174 related to what appeared to be at the time an inequitable treatment of small startup companies where the R&E was in its infancy. These firms were not allowed under the then current law from deducting its R&E expenses, while more established companies with more mature R&E projects could take the deduction on these expenses. The deductibility of these expenses was clearly considered as an incentive for companies to innovate and commit resources to new R&E projects. So research and experimentation, which is referred to throughout this presentation as R&E, these expenditures are defined as research and development in the laboratory sense, including all costs incident to the development or improvement of a product. This definition is much more expansive than that used for qualifying IRC Section 41, which is the R&D tax credit, which are limited to just wages, supplies, and contracted research. Experimental sense means that activities intended to discover information to eliminate uncertainty as to the development or improvement of a product. And uncertainty exists regarding the taxpayer's capability to achieve its intended technical results or regarding the appropriate design of the product. And then the ultimate success or failure is irrelevant for the expenses associated with these activities in order to qualify. R&E expenditures under IRC Section 174 are all-encompassing, anything incident to the development. These include wages for employees directly involved in the research, as well as those providing direct supervision or direct support to the research. Supplies, materials, ingredients used or consumed in the research process. Contract research is related to third parties paid to assist in the development, but also included as 174 expenses are utilities and depreciation for the building and equipment used in the development. Also attorney fees paid for the research and or securing of patents. And then finally, certain overhead expenses related to the research, and I've included that revenue ruling citation for your reference. Now, certain expenses are specifically excluded from the definition of research and experimentation, including routine quality control testing, efficiency surveys, management studies, consumer surveys, including focus group testing and market research, advertising or promotions, acquisition costs of patents, models, production or processes, and activities related to the arts or humanities, otherwise known as the soft sciences. Now we'll talk a little bit about the new Section 174 rules. So this is, again, is a committee report from the new rules. It makes the argument that since the taxpayer benefits from the R&E well beyond the current year, that these tangible and intangible property should be capitalized and amortized over several years, the same as other tangible property, such as buildings, machinery, and specifically includes the development of software. Now, the new 174 rules require capitalizing and amortizing of specified R&E costs over 5 years for domestic research and over 15 years for foreign research, beginning at the midpoint of the year during which the expenses are incurred. Specified R&E expenditures are those paid or incurred by the taxpayer, quote, in connection with the taxpayer's trade or business. Now, I'd like to introduce a case study here to drive home the point. Here we have a company that has developed software for its internal use. Typically, this type of general and administrative software development would have to meet the high threshold of innovation test to qualify for the IRC Section 41 R&D credit. However, it does not meet that threshold. So the question is how to treat these expenses for tax purposes. The company incurred $1 million of domestic R&E and $2 million of foreign R&E. If the cost were incurred in 2021, these costs could be fully deducted under Rev Proc 2000-50. If the costs were incurred in 2022, the $1 million of domestic R&E expenditures is capitalized and amortized over 5 years, while the $2 million of foreign R&E expenditures is capitalized and amortized over 15 years. And again, amortization begins at the midpoint of the year. So what does this mean? We're next going to discuss the interplay between the expenses under 174 and Section 41. So again, the following applies to tax years beginning in 2022. So starting with Section 174, taxpayers and CPAs need additional guidance from the IRS. This includes understanding what data is available for tax and financial reporting. For example, R&D tax credit work papers, US GAAP work papers related to ASC 730 and ASC 350, as well as any Section 174 studies that are performed. The Tax Cuts and Jobs Act back in 2017 left Section 41 credit, R&D credit, largely unchanged. There wasn't really any effect to the credit itself, how it's calculated, what qualifies. Qualified research is defined as research with respect to expenditures which may be treated as specified research or experimental expenditures under 174. So 2022 and forward, if we look at the committee reports, this is for the Section 41 R&D credit, which again has not been changed really much in the past 30 years. We find two interesting comments. First, it says that the credit is for the R&E wage expenditures incurred, quote, in carrying on a trade or business. Second, the tax credit is available for R&E expenditures, whether or not the taxpayer has elected under 174 to expense or amortize these expenses. And since the credit is available only for expenditures paid or incurred in carrying on a trade or business within the meaning of IRC Section 162, it is not available for R&E paid or incurred by a taxpayer merely in connection with, but not in carrying on a trade or business. So a distinction is clearly made with 41 that if you're already carrying on an existing trade or business, then distinction being made between carrying on and simply in connection with. And we'll find out a little bit more about what carrying on and in connection with means. It is defined either through different regulations or in court cases as judges opine. So Section 41, there's may be language, and we'll talk about that here briefly. Section 41 R&D credit uses the term may be, but it does not use the term must be. And why is this important? Why is this a big deal? Well, there's a court case called Norwest Corp. And in the decision, the judges said, we believe that the phrase, quote, the research expenditures may be treated as expenses under Section 174 is meant to require the taxpayer to satisfy all the elements for a deduction under 174. The conference report cited the House conference report cited in Norwest that this also supports this. The conference agreement limits research and experimentation expenditures eligible for the incremental credit to research or experimental expenditures eligible for expensing under 174. So I kind of fumbled over that a little bit. The bottom line there is that historically, prior to 2022, all that was necessary to claim an R&D credit was that the expenses considered for the R&D credit had to first be eligible for treatment under 174. And prior to 2022, that proper treatment was to either fully deduct in the year that they were incurred those expenses related to the R&D that was being performed, or to capitalize and amortize those expenses over the useful life of that product or project. So now what we have is that basically what this is saying is that the result is that the expenses ineligible for 174 treatment are ineligible for the research credit. They have to first be eligible for 174, and then you can determine whether they are eligible under the much stricter constraint of Section 41. So just as an example, and we went through the examples earlier, but in this example, mining or mineral exploration costs are ineligible for 174 treatment. Therefore, they are ineligible under section under 41. And so what we're going to find here is that there's a distinct change in direction as to the purpose of 174. If in fact 174 has to be the first test that is passed, proper treatment of your expenses under 174 is to capitalize and expense rather than to expense and deduct those expenses. Now, you may see the value of the R&D credit actually go down because the only way that you get to a high tax bill is through eliminating deductions, which it appears that's what's the purpose of the Section 174 regulations. So many on this call that have been familiar with the R&D tax credit may find this slide familiar. This is the tax definition of research and development, also known as the four-part test. And these tests are applied to what's known as the business component, which is either the product that you're making, the process that you're creating or improving, the invention that you're making, the formula that you're creating, or the software that you're developing. So the first test is that the project has to be technological in nature. In other words, the activities that are associated with this project must fundamentally rely on principles of hard science. So these would be your physical sciences, your biology, your engineering, or computer science. The second test is that it must fill a permitted purpose. In other words, the activity must relate, must intend to either be to create something new, either a new product or process, or an improved product or process, so long as the improvement is intended to improve some aspect of function, performance, reliability, or quality. And as we've said before, you can fail in your permitted purpose and not meet your stated requirements or specifications, and we could still capture the cost of that engineering effort towards the credit. The third test is the elimination of uncertainty test, and we get that from Section 174. The activity must be intended to discover information to eliminate uncertainty concerning the capability, method, or design for developing or improving a product or process. So in other words, 3 questions have to be asked. If you answer yes to any one of these, you meet that elimination of uncertainty test. Capability, is this technically feasible? Number 2, excuse me, if you're certain you can do this, but you're not certain as to the appropriate method or the appropriate design you're going to employ, then you meet that third test as well. Finally, there's a process of experimentation. And to help eliminate that uncertainty, what you would need to do is to employ an evaluative process whereby you are evaluating and testing various methods, various alternatives to achieve your end result, whether those alternatives are techniques or methods, or they are more of a physical nature, like different types of material, different ingredients, different components, iterations on the design itself. And that does not just include physical representations, but also virtual modeling, simulating, or systematic trial and error. Now, to the extent that the activities qualify, the credit calculation includes wages from employees performing the research. These include partnership earnings subject to self-employment tax. It includes wages used to calculate the work opportunity credit, and employee retention credits as well. Supplies are included so long as they are tangible property used or consumed in qualified research. Examples include compounds, chemicals, prototype materials, ingredients, etc. It also excludes land and property depreciable in the hands of the taxpayer. And then finally, payments made to third parties to conduct research on the taxpayer's behalf also qualify for the credit. Now, the percentage of the amounts to be included vary based on who's performing the research and for what purpose. So why the big deal in the language in carrying on and in connection with regarding research costs conducted by a trade or business? Get into that here in the coming slides. So right now, Section 162 of the Internal Revenue Code allows for a deduction of all ordinary and necessary expenses, quote, in carrying on, unquote, any trade or business. The trade or business was defined by the Supreme Court in 1987 as an activity conducted with continuity and regularity and with a primary purpose of making income or a profit. However, the IRC does not define in connection with. It has, however, been interpreted through different court cases throughout history. In Snow v. Commissioner, the Court of Appeals ruled Burns Investment was not engaged in a trade or business, citing Deputy v. DuPont in that a trade or business involves holding oneself out to others as engaged in the selling of goods or services. And in 1974, the Supreme Court considered whether Section 174 was enacted to dilute some of the conception of ordinary and necessary. In rendering its decision, it looked at the congressional intent of Section 174. And it held that the Section 174 deduction is available to startup ventures incurring research and experimentation expenses, even if the taxpayer is not yet engaged in the business of selling goods or services utilizing the R&E results. Now, regarding the in connection with a language in this IRS Chief Counsel memorandum, the IRS concludes that a taxpayer incurred R&E expenditures in connection with the trade or business, and therefore is entitled to deduct those expenses under 174. Now, the only difference between 174 and 162 relating to deducting expenditures is focused on the timing of the business operations. The courts have held that in connection with allows a taxpayer to deduct R&D expenses prior to the actual commencement of a trade or business, while under 162, a taxpayer must be carrying on while already engaged in a trade or business. Now, there's IRC Section 195, which relates to expenditures incurred by a startup company. These expenses are to be capitalized and amortized, with the exception of a small allowance. Startup expenditure is defined as any amount paid or incurred, quote, in connection with a trade or business. Section 174 expenses are specifically excluded from 195 treatment. Now, things to consider going forward. Since the 174 expenses have to be capitalized and amortized as the law stands now, over 5 years for domestic and over 15 years for foreign. If you do have foreign operations, the question is it better to buy software? First of all, is it better to buy software or to develop software in-house? And if capitalizing and amortizing your development costs for software is mandatory, which it is under new 174 rules, is it better for your company to buy the software or to continue developing it in-house? Second question is related to foreign versus domestic R&D. Is it better to bring offshore development back to the US? By doing so, you're able to capitalize and amortize over 5 years versus 15 years. So you get a better tax treatment for bringing those resources onshore. Is it better to classify expenditures under 162 or 174? Under 162, taxpayers can deduct all ordinary and necessary business expenses incurred in carrying on any trade or business. And under Section 174, specified research or experimental expenditures means that those research expenditures paid or incurred in connection with the taxpayer's trade or business. So question, can taxpayers carry on a trade or business? Can taxpayers who are carrying on a trade or business deduct R&E expenses under 162? That is right now that question is being considered. Right now, the law as 174 is written is no. But if we look to the committee report for Section 41, it states that a non-refundable income tax credit is allowed for expenditures paid or incurred in carrying on a trade or business. Isn't that the same language that's used under to define a deductible expense under Section 162? The answer is yes, it is the same language. However, is the IRS going to change the wording or provide additional guidance to kind of square that inconsistency here? So let's talk a little bit about what's next, kind of what to expect and what if. So what we kind of expect, and I noticed that Kevin Zolriasatane joined our panel. He's the R&D Tax Credit Principal, the leader of our R&D group here at KBKG. But he'll want to weigh in and also we'll be able to answer some questions during the Q&A session here. But right now, the IRS needs to issue additional guidance. And so that is what we expect. We expect over the next month or so, there will be new forms created for 2022 for the R&D credit. There's going to be instructions on exactly how to complete this. They're going to need to, without going into the weeds as to how an R&D credit is calculated, one of the methods used is to consider prior year qualified research expenses in creating that base amount that creates that increment that you get the credit on. Well, what happens if we now have to go back and have to adjust the base period for the 3 prior years to account for expenses that were properly treated as 174, but now are inconsistent with the new Section 174 rules? Also, what's the value now of a reduced credit? In other words, the credit, when you claim a credit, a full amount of the credit, you have to add that back to income right now. The 280C reduced credit election allows you on an original timely filed return to take a reduced credit and not have to adjust your deductible expenses. Well, what deductible expenses? If 174 is doing away with deductible expenses, how is the reduced credit election going to be handled? These are questions that the IRS, that we need guidance from the IRS on. As far as what Congress can do, the expectation is during this lame duck session of Congress after the midterm elections, there's likely to be an extenders package passed. And that would be a more proper vehicle, perhaps to attach 174 revisions or an all-out repeal of the new 174 requirements. There has been bipartisan support in Congress, both in the Senate and the House, for repealing or extending the start date, delaying the start date, I should say. It was included both in the Build Back Better plan and the Inflation Reduction Act, but it was ultimately pulled in favor of the overall intent of the bill. In Build Back Better, I think there was just too much in it. And Inflation Reduction Act, they wanted to keep it focused on the merits of the bill itself and not add anything new to it. But there has been, just as recently as May, the Senate voted like 95-0 in favor of revising or repealing this, but it has to be reconciled with House. There has been 150 companies got together and wrote a letter to Congress urging them to do this. There's strong bipartisan support as well as industry support in repealing this. So that is what I would expect to happen here over the next month or so prior to the new year starting. What if the new 174 regulations remain in effect? You'll need to be prepared to examine any of your 162 expenses that you may have included in the past for Section 41 credit, and make sure that they are properly capitalized and amortized to remain compliant with the new rules. Ultimately, challenges will, if this stands, challenges will be made to these new 174 regulations. They'll be handled, likely they'll be handled through the IRS audit process and appeals, and ultimately be decided in the courts. So with that ends my formal presentation here, and we can maybe I'll turn it back over to Eric. Eric, would you like to make a few comments and maybe lead us into the Q&A session?
Sure, Michael, thank you for that information. I think that's gave a good background as to how the law evolved and why we are where we are right now. Couple of questions have come through. I'm gonna we'll start with first one that came in on abandoned project costs. It looks like the question is, can I write off my abandoned project costs considering the considering now that there's a 5-year amortization rule? So in other words, I think what they're asking is, you know, instead of capitalizing and amortizing over 5 years, what if I abandon my project costs? Can I write them off right away and not wait to write them off over 5 years? So a lot of R&D, I think some of it's good and some of it ends up not being good. Can I take the category that's not good and write it off right away?
Yeah. Hey, Eric. Unfortunately, no. The new rules mandate that even abandoned projects must continue to be capitalized and amortized over either 60 months or 180 months, depending on whether it's domestic or foreign research.
All right, thank you. That was Kevin.
Yeah, Kevin.
Yeah, thanks, Kevin. Another question: if I don't claim the R&D credit, do I still have to capitalize and amortize my R&D expenses? So let's say I traditionally have the R&D credit and I've reported my R&D expenses and deducted them, but also calculated the credit. What if it turns out I determine that maybe I don't have R&D credit capability? Do I still have to capitalize my R&D expenses?
Yeah, that's a good question, and one that we're getting a lot of. So 174 and 41 are mutually exclusive, right? They're two different code sections. I always like to say, you know, 174 is like the ocean, 41 is like a lake, right? Because 174, there's anything and everything can qualify under 174. It's almost easier to list out the things that don't qualify as 174 expenses and the things that do. Section 41 is primarily limited to 3 or 4 types of expenses: wages, supplies, contract research, and computer time sharing costs are generally what you would capture under Section 41. So generally, even if you are not claiming a research credit, and I'll give you an example. Let's say you have a taxpayer that's, creating a piece of software that's deemed internal use software that doesn't meet the high threshold of innovation tests that are required for qualification under Section 41. That taxpayer would still have to capture those costs as Section 174 costs and capitalize and amortize them. So even though they don't qualify for a Section 41 credit, those expenses need to be capitalized and amortized over the life of the amortization period. Also foreign research, right? Foreign research isn't something that we normally capture under Section 41, but it is still something that would need to be captured for 174 purposes. So while there's overlying rules between the two things, even if you do not claim a research credit, you still need to consider these 174 rules for taxpayers.
Thanks, Kevin. You're a bit of a downer. I've got another question here. Are the 174 expenses that are amortized now, so let's assume we're going to capitalize and amortize them, does that happen at the entity level, say at the S corporation or partnership level, or are they passed through separately stated as expenses and then capitalized and amortized at the individual level?
They tend to be capitalized and amortized at the entity level, and then the effects on net income are passed through to the individual shareholders of the company.
Great. All right, thank you. One last question. This is mine. If you could put a number on the likelihood of this being repealed, and I just mean specifically the capitalized amortization aspect of the rule, of that being repealed or delayed for 2022, what number would you put on it? And the reason I ask is this is, it's quite significant as we're doing our tax projections for companies here, whether we deduct in full the R&D expenses, or if we, have to add them back and just deduct, say, 20% of them to amortize them over 5 years. So it's quite a big difference as we prepare projections here. And, we'd like your expertise number as to what do you think of, on a scale of 1 to 100, the repeal is going to happen?
Yeah. So in terms of appetite, I would say 90% chance, right? There's a strong appetite from both Democrats and Republicans to change it. In fact, I think the results of the election make it more likely than less likely that it gets repealed or gets kicked down the road. My only hesitation to all of that is that you have to bank on Congress to do their jobs, and that's a hard thing to bank on. But there has been a strong appetite for repealing it from both sides. It's always been. I mean, removing politics out of it. It's just a bad law. It's very punitive to the things that we're looking to accomplish as a country. So I think everybody sees that there's a lot of money pouring into it to get it, fixed. The one thing that's been lacking is a vehicle for doing such. And what we are hopeful is that it's either part of a tax extender package or it's part of a funding package for the government through reconciliation or the like, where it gets addressed. But, we're running out of time. So, we're hopeful, but still kind of uncertain. I would put it at 50-50 that it happens, 90-10 in terms of appetite for it happening.
Okay. And we have time because they usually do this sometime in January, right? And then retroactive it and make everybody scramble for, adjusting to a new tax law that's retroactively effective. I think they're getting pretty good at that.
Yeah. Yeah. Well, they used to do that all the time with Section 41. So,
right.
Yeah, I've been doing this for almost 20 years. So every 2 or 3 years, I would start getting my resume ready, and then they would come back and extend it. So hopefully they fix this too.
Right. There's a couple more questions that have come in as we've been talking. One of them is, do the amortization rules sunset like a lot of other provisions in the Tax Cut and Jobs Act? So there's a lot of sunsets out there. I think it's 25, 26. You got some sunsetting. Is this part of that? Sunsetting?
No, it's not. Yeah, most of the sunsets are on the individual side. Some of the on the entity side or corporate side, especially this stuff there's no sunset.
Okay. Another question that came in is overhead part of the 174 calculation purposes, and how might you calculate it if it is?
It is part of the 174 calculation, and there's so taking a step back, a lot of the research that you saw in the presentation is stuff I'd been working on for about 18 months, and the in connection with versus carrying on language. I felt like there was, a gap between what congressional intent was and what the interpretation of the law was. And we were kind of on KBKG, especially me, was kind of on an island when it came to our positioning with, is 174 treatment mandatory, or is it more, a leveling of the field for startup type ventures so that they had an avenue to take the deduction, where larger taxpayers were already taking the deduction. And so we scheduled a presentation kind of similar to the one that you just sat through with the Office of the General Chief Counsel. And we started it off with a question. We said, is 174 now mandatory? Meaning, if you're a taxpayer that's developing anything, are you required to now capitalize and amortize those costs? And they started off by saying, yes, you are now required to do that. I said, okay, great. And then we went through our presentation, and I, walked them through my research and the committee reports and all of this stuff. And I said, the way it's written here, it sounds like it's optional, right? And it all comes down to the in connection with language versus the in carrying on language. The in connection with language, when you look at the tax code, it's really in 174 and 195, and they always have to do with startup expenses, right? Everywhere else where you're talking about carrying on, you're talking about current deductions. So, we walked through that for a little bit, talked about overhead expenses and how you would do it. And they said, okay, we kind of see what you're saying. We know that we have to put out guidance. Overhead's tough to qualify, although there's a CCM out there that basically says you have to identify any overhead expenses that are incidental to the development of whatever it is that you're developing, and capture those expenses as 174. Basically they were saying, we don't know how we're going to do this, but we need to put out some guidance so that people have some sort of idea what costs they need to capture and how to capture those costs. But they did say, they gave us an affirmative answer when it was, are you expecting overhead to be part of those 174 calculations? So the short answer is yes. The long answer is we have no clue how to calculate it right now. If I was a CPA and I had a client that was clearly doing research and development, I don't know that I would go after every penny and capture every penny as 174 costs. If they have audited financial statements, they're probably capturing under GAAP some research and development costs. Those are probably the costs that I would look to capture as 174 costs. If they don't have audited financial statements, the next step is, are they claiming a research credit, or do they qualify for a research credit? If so, those are the costs I would capture as 174. It would be a simple reclassification of expenses. But I don't know that I would take a, fine tooth comb and go through everything to see if I don't think the IRS even knows how to audit this yet. They're still catching up. We're still teaching them how to do Section 41 audits. So Section 1, it's going to be 5 to 10 years before they get their arms around 174.
Right. But they do have 45,000 new auditors starting, so maybe they'll be on this one. Kevin, why don't you write the draft guidance for them and submit it? Let them take the credit for it, but then you get to put your mark on it.
Well, so after the presentation we gave, they told us that they would invite us back to comment on, what they're putting together. So we're still, well, hopefully they just change it back. They repeal it. That would be the
Right.
best solution. But when we do go back and comment, we'll certainly bring up some of the issues that we're seeing and hearing from other people.
All right, thanks, Kevin. So we are at the end of our questions here. I think without anything else coming in, we'll say thank everyone for attending. KBKG, thank you for your presentation here. Great materials. And to those attending, if there's any questions that you have that come up after this, please feel free to email us. We've got, we'll have a link to this seminar also on our website. And so there'll be other ways to access and ask us questions or look at information on this. All right, thank you all.
Thank you.